When the market is overvalued and you're a dividend investor, what do? Well, I like to keep my watch list topped up and look for individual opportunities in the market because there's always opportunities if you're looking for them, and there are some that you shouldn't ignore while everyone is hiding in cash, letting inflation burn away their money. So in this video, I want to talk about 2 dividend stocks on my watch list that's pretty interesting, and I'd love to know what you think in the comment section below. As usual, if you do learn something new, it will mean the world to me if you could gently smash the like button somewhere around here, and no, this video is not financial advice or recommendation to do anything. So without further ado, let's go. Before I bring you into my computer and talk about the individual opportunities, there are a few things that I think make a great dividend stock. Now, firstly, free cash flow growth. I used to say that earnings growth is a key ingredient to a great dividend stock, but what I realized is that it's much harder to lie about your numbers when you're looking at free cash flow. So much prefer free cash flow now for dividend stocks. And secondly, strong balance sheet. And what I mean by that is, do they have enough current assets, cover their current liabilities? How much debt do they have? We will go into that in an example in just a second. And thirdly, do they have a moat or glimpses of a moat? And the whole idea of a moat is that they're defending their ability to generate cash flows in the future. And what I mean by that is, do they have a strong brand? Do they have a network effect that as more people jump on the platform, there's more value that's extracted for the entire network? Or do they have a cost advantage because they are at a certain scale that they can manufacture at a lower cost? Above all else, I've done a very simple discounted cash flow model on both companies to make sure I am not wasting my time. At the same time, I would likely suggest you to play around with the template yourself. The link is in the description box below. And if you want to know how to use the template, I've talked about that in my how to research stocks before investing video. So feel free to check out that video after this one. The first company I want to talk about is Nrw Holdings. And I have to admit, this chart doesn't look good, but it's also one of the reasons why I'm interested in the company in the first place. It came out of my screening process, and I had a lot of fun learning about this company, a lot of things I didn't know about mining. I'll talk more about what they do in just a second. I just want to give you some basic statistics first. In terms of market cap, they're trading at $666 million at the moment. Not exactly the luckiest number. I much prefer it to be $690 million, 420,000, but we got to work with what we have, right? The dividend yield is at 5.5%, but you got to take that number with a grain of salt because the share price have corrected quite substantially since then. So as the share price comes down, the dividend yield is going to look really high. In terms of understanding the business, what was really interesting to me is that I always thought that copper mines, gold mines, lithium mines, they would do their own mining operations. But it turns out that they actually outsource some of that mining operations to a company like Nrw Holdings. As a side note, if you want to learn about a company really quickly, what I like to do is go to their main website, go through their service offerings, read through some of the key pages, and mix it together with investor presentation. Gives you a pretty good overview of what the company actually does. Now, there are 4 main business units for Nrw Holdings. You have civil, mining, drill and blast, minerals, MET, if you will. So where they make most of the money is actually in civil and mining. Civil is mostly in developing public infrastructures like roads, bridges, rails, etc. And mining is where they make most of the money. And Nrw Holdings, surprisingly, they can play a pretty comprehensive part in the entire mining lifecycle. They could develop the mine, or they could manage the entire mine. They can rehabilitate the mine after it's been mined, or they can lease out equipment. So it's quite interesting to me that Nrw Holdings is actually not exposed to the fluctuating commodity prices, but they're exposed to the increased investment to extract materials from the mine. When it comes to the first criteria of free cash flow growth, what I like to do is come to Ticker, and I left an invite in the description box below, and no, I am not sponsored. And then you go to estimates, and then I scroll down to free cash flow, click it so that it charts the graph. And you can see that there's been a really nice growth trajectory to free cash flow. The whole idea here is that if their free cash flow isn't growing, then our dividend checks isn't going to be all that sustainable. So that's one of the main reasons why we want to see whether free cash flow is growing. Now, when we go back to the numbers, you can see that from 2017 to 2022, the compounded annual growth rate for free cash flow is around 31%, and that's pretty nice to see. But we got to put things in perspective. So if we stretch the time frame a little bit, you can actually see that Nrw Holdings have a cyclical business. Essentially, you have years where they do pretty good, and then you have years where they don't do so good. And then now they're kind of in that good trajectory again. So the question is whether I think the free cash flow will continue to grow in the future and not experience this negative free cash flow couple years, right? Personally speaking, I'm not an oracle, but I believe that the public infrastructure spending from both Australia and also in foreign countries, not to mention the EV movement, will ultimately be a strong tailwind for a company like Nrw Holdings to continue to generate strong free cash flows. But again, we have to wait and see. The next thing I like to do to look at whether Nrw have a strong balance sheet is I like to go to financials, and then I click on balance sheet, cash, current assets, and then current liabilities, total equity, and also total debt. That gives me a pretty comprehensive view. So let's talk about current assets versus current liabilities first. Now you can see that they have more than enough current assets to cover their current liabilities, and that's a great sign, number one, which means that in the short term, they should be able to handle any external shocks, not a problem. And if I just click total cash and short-term investments, you can see that out of that $600 million worth of current assets, 170 is straight cash. So they can either deploy that cash in M&A transactions to grow faster or even more equipment. In terms of debt to equity ratio, if we do 309 divided by 472, it's around 0.65. And that means that for every $1 worth of equity, there is 65 cents of debt. And that's great. When it comes to the third criteria of having a moat, that's just a fancy way of whether the company can defend their ability to generate cash in the future. I think that Nrw have two moats. First, I think that they have a brand moat. If they don't have a brand moat, it becomes pretty hard to get a contract with Rio Tinto or Pilbara Minerals, which is a pretty big market cap lithium project in Australia. And the second moat is that as you develop the brand, the switching costs for both Rio Tinto, Pilbara, or other mining projects becomes much higher. Because if you were to try another mining operator instead of Nrw, you are taking on additional risk because you don't know whether that mining operator is going to work out for you. The final question is, well, what is the outlook for this business? Is this a short-term thing or is this a long-term thing? Personally speaking, I'm still trying to figure that part out. But the infrastructure announcements from both Australia and also foreign countries, not to mention the electrification process, I think those are very strong tailwinds for Nrw Holdings. For full transparency's sake, as I'm recording this video, I do have a very small position in Nrw. And that's mostly because I'm bored and I need some skin in the game to actually learn about the company properly. So the next company I want to talk about is Thor Industries. This is currently a $6 billion market cap RV company. Now I know what you're thinking, RVs, it's pretty boring. Why are we talking about RVs? But the financials is not boring, and that's actually one of the main reasons why it's on my watch list. It's currently trading at a 1.45% dividend yield, and it came onto my screening process only because they had a pretty substantial correction from the beginning of May to around middle of June. It's almost like a 30% correction. But the thing is, when I first came across this opportunity, one of my bigger concern is, hey, isn't there more demand for people who want to travel by air after the economy reopens? That was actually one of my initial thoughts. But after I spent a little bit more time thinking about it and doing a little bit more research, I realized that the CEO of Thor Industries was asked this exact question. So before I share my thoughts, let's hear from him in terms of what he has to say about that.
So you don't see it as a threat that, say, the airline executives are so excited about the pent-up demand, and Booking Holdings tell us there's going to be so much appetite to travel once people get vaccinated. Is that not a direct headwind to your business?
You know, it's a small percentage of the pandemic buyers that have come to our stock into our product. It's really been a lot of our existing customers that were already in the buying mode going into the pandemic. We were off to a great year before COVID, so the lifestyle has been growing going into this. We think it's brought just more people to it. And I think psychologically, a lot of people are still going to be hesitant to travel and vacation in different ways once they've tried an RV lifestyle.
Personally, I agree with the CEO that a larger portion of our population still won't feel comfortable traveling by air, at least for a little while. So I think that RV opportunity is here to stay for the short to medium term. The variant obviously doesn't help as well. At the same time, I have to say, even before the pandemic, my household consumes a lot of travel content. And a lot of travel bloggers tends to be RV lifestyle travel bloggers. And if you're really into that lifestyle, you're really, really into it. It's a very, very passionate community. And I think what's really appealing about the RV lifestyle is that you get to pull away from this fast moving, very distractive world into something that's slow moving in the nature, and you get to slow everything down and enjoy life, for what it is. Because I think that the RV opportunity is here to stay, at least in the short to medium term, I kept digging. So the next thing we'll talk about is the financials. When it comes to free cash flow growth, we do the exact same thing as we did to Nrw Holdings. We go back to ticker, go to estimates, and then we go to free cash flow, and we're trying to understand whether free cash flow is growing. Because if it's not, then it means that our dividend checks are not sustainable over time. From this perspective, you can see that from 2016 to around 2020, it's growing pretty nicely. And 2020 had a massive jump, and that's partially because it pulled forward quite a bit of demand for RVs because people couldn't travel by air. Now, some analysts believe that free cash flow will subside in 2021 because they are reinvesting a little bit more into CapEx. So we'll see about that. But in 2022, I think they'll reap the benefits, and free cash flow will go back to even higher levels. But overall, you can see that from 2016 to 2022 estimated, the compounded annual growth rate for free cash flow is around 15%. So free cash flow growth is definitely a check for me. The next thing we should do is the balance sheet. With balance sheets, what we want to do is go back to financials, click on last 12 months, and then you want to go to balance sheet and click on cash and short-term investments, current assets, current liabilities, total equity, and total debt. So what we'll do first is look at total current assets to current liabilities. And you can see that historically speaking, they've managed their balance sheet pretty well, right? There haven't really been a time where current assets is less than current liabilities, which will honestly worry me a little bit. You can see on the April 30th of 2021, the current assets, there's almost $2.8 billion worth of current assets to almost $2 billion worth of current liabilities. So plenty of current assets to cover the current liabilities, which really means that in the short term, they shouldn't have any problem dealing with external shocks. And then when we look at the cash and short-term investments, there's almost $300 million worth of cash. So they can either deploy that in M&A transactions, but we'll have to see how they decide to use that cash. But at least for now, it's looking pretty good to me. Final thing I like to do is look at the total equity to total debt. And one of the easiest way to get the debt to equity ratio is to divide this number by 2757, which is the total equity number. And you should get a 0.64 number, which means that for every $1 worth of equity, there is 64 cents worth of debt. Quite safe, honestly, in my opinion. The reason why I like to look at this from a historical chart, and I'm sorry I didn't get a chance to do that for Nrw, is that you can see that in 2019, there was a very brief moment where they had a lot more debt than equity. I would be somewhat concerned during that period, but as I dug a little deeper, it turns out that they took on debt in order to acquire this company right here, which is a RV manufacturing company. So they took on debt in order to acquire a company, but since then, they've been pretty diligently paying down that debt, right? So at this current stage, I would actually say that they have a very, very solid balance sheet. When it comes to Thor Industries Moat, it was really interesting to me that when I first started doing research, I was looking for Thor RV reviews. And back in 2017, 2018, the Reddit comments was around the build quality wasn't that great. So they didn't have the best rep for the highest quality of RVs. But over time, they actually bought multiple companies that have really high quality RVs, and it seems like the brand have been building on an upward trajectory since then. Now, if you do have an RV from one of the Thor brands, let me know in the comment section below how you like it. But so far, from the recent reviews I've read, I will give them a pass when it comes to having a brand moat. At this current scale, it definitely seems like they'll have a cost advantage because comparing their costs to a smaller manufacturer, it's just going to be two worlds apart. So they definitely have a cost advantage with their scale currently as well. And for full transparency's sake, no, I don't have a position in Thor Industry as of recording this video. Overall, Nrw Holdings and Thor Industries is pretty high up on my dividend stocks watch list. But what do you think? Do you think that I'm missing something with these two companies, or do you think that there are better dividend stocks out there? Let me know in the comment section below. Thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.